F. Berkshire's recapitalization. At the annual meeting, you will be asked to approve a recapitalization of Berkshire, creating two classes of stock. If the plan is adopted, our existing common stock will be designated as Class A common stock, and a new Class B common stock will be authorized. Each share of the B will have the rights of 1/30th of an A share with these exceptions. First, a B share will have 1/200th of the vote of an A share, rather than 1/30th of the vote. Second, the B will not be eligible to participate in Berkshire's shareholder designated charitable contributions program. When the recapitalization is complete, each share of A will become convertible at the holder's option and at any time into 30 shares of B. This conversion privilege will not extend in the opposite direction. That is, holders of B shares will not be able to convert them into A shares. We expect to list the B shares on the New York Stock Exchange, where they will trade alongside the A stock. To create the shareholder base necessary for a listing, and to ensure a liquid market in the B stock, Berkshire expects to make a public offering for cash of at least 100 million of new B shares. The offering will be made only by means of a prospectus. The market will ultimately determine the price of the B shares. Their price, though, should be in the neighborhood of 1/30th of the price of the A shares. Class A shareholders who wish to give gifts may find it convenient to convert a share or two of their stock into Class B shares. Additionally, arbitrage-related conversions will occur if demand for the B is strong enough to push its price to slightly above 1/30th of the price of A. However, because the Class A stock will entitle its holders to full voting rights, these shares will be superior to the Class B shares, and we would expect most shareholders to remain holders of the Class A, which is precisely what the Buffett and Munger families plan to do, except in those instances when we ourselves might convert a few shares to facilitate gifts. The prospect that most shareholders will stick to the A stock suggests that it will enjoy a somewhat more liquid market than the B. There are trade-offs for Berkshire in this recapitalization, but they do not arise from the proceeds of the offering. We will find constructive uses for the money, nor in any degree from the price at which we will sell the B shares. As I write this, with Berkshire stock at $36,000, Charlie and I do not believe it undervalued. Therefore, the offering we propose will not diminish the per-share intrinsic value of our existing stock. Let me also put our thoughts about valuation more boldly. Berkshire is selling at a price at which Charlie and I would not consider buying it. What Berkshire will incur by way of the B stock are certain added costs, including those involving the mechanics of handling a larger number of shareholders. On the other hand, the stock should be a convenience for people wishing to make gifts, and those of you who have hoped for a split have gained a do-it-yourself method of bringing one about. We are making this move, though, for other reasons, having to do with the appearance of expense-laden unit trusts purporting to be low-priced clones of Berkshire and sure to be aggressively marketed. The idea behind these vehicles is not new. In recent years, a number of people have told me about their wish to create an all-Berkshire investment fund to be sold at a lower dollar price. But until recently, the promoters of these investments heard out my objections and backed off. I did not discourage these people because I prefer large investors over small. Were it possible, Charlie and I would love to turn $1,000 into $3,000 for multitudes of people who would find that gain an important answer to their immediate problems. In order to quickly triple small stakes, however, we would have to just as quickly turn our present market capitalization of $43 billion into $129 billion, roughly the market cap of General Electric, America's most highly valued company. We can't come close to doing that. The very best we hope for is, on average, to double Berkshire's per-share intrinsic value every 5 years, and we may well fall far short of that goal. In the end, Charlie and I do not care whether our shareholders own Berkshire in large or small amounts. What we wish for are shareholders of any size who are knowledgeable about our operations, share our objectives and long-term perspective, and are aware of our limitations, most particularly those imposed by our large capital base. The unit trusts that have recently surfaced fly in the face of these goals. They would be sold by brokers working for big commissions, would impose other burdensome costs on their shareholders, and would be marketed en masse to unsophisticated buyers apt to be seduced by our past record and beguiled by the publicity Berkshire and I have received in recent years. The sure outcome? A multitude of investors destined to be disappointed. Through our creation of the B stock, a low-denomination product far superior to Berkshire-only trusts, we hope to make the clones unmerchandisable. But both present and prospective Berkshire shareholders should pay special attention to one point. Though the per-share intrinsic value of our stock has grown at an excellent rate during the past 5 years, its market price has grown still faster. The stock, in other words, has outperformed the business. That kind of market overperformance cannot persist indefinitely, neither for Berkshire nor for any other stock. Inevitably, there will be periods of underperformance as well. The price volatility that results, though endemic to public markets, is not to our liking. What we would prefer instead is to have the market price of Berkshire precisely track its intrinsic value. Were the stock to do that, every shareholder would benefit during his period of ownership in exact proportion to the progress Berkshire itself made in the period. Obviously, the market behavior of Berkshire's stock will never conform to this ideal, but we will come closer to this goal than we would otherwise if our present and prospective shareholders are informed, business-oriented, and not exposed to high commission salesmanship when making their investment decisions. To that end, we are better off if we can blunt the merchandising efforts of the unit trust, and that is the reason we are creating the B stock. We made 2 good-sized offerings through Solomon during 1996, both with interesting aspects. First was our sale in May of 517,500 shares of Class B common, which generated net proceeds of $565 million. As I have told you before, we made this sale in response to the threatened creation of unit trusts that would have marketed themselves as Berkshire lookalikes. In the process, they would have used our past and definitely non-repeatable record to entice naive small investors and would have charged these innocents high fees and commissions. I think it would have been quite easy for such trusts to have sold many billions of dollars worth of units, and I also believe that early marketing successes by these trusts would have led to the formation of others. In the securities business, whatever can be sold will be sold. The trusts would have meanwhile indiscriminately poured the proceeds of their offerings into a supply of Berkshire shares that is fixed and limited. The likely result? A speculative bubble in our stock. For at least a time, the price jump would have been self-validating in that it would have pulled new waves of naive and impressionable investors into the trusts and set off still more buying of Berkshire shares. Some Berkshire shareholders choosing to exit might have found that outcome ideal, since they could have profited at the expense of the buyers entering with false hopes. Continuing shareholders, however, would have suffered once reality set in, for at that point, Berkshire would have been burdened with both hundreds of thousands of unhappy indirect owners, trust holders that is, and a stained reputation. Our issuance of the B shares not only arrested the sale of the trusts, but provided a low-cost way for people to invest in Berkshire if they still wished to after hearing the warnings we issued. To blunt the enthusiasm that brokers normally have for pushing new issues, because that's where the money is, we arranged for our offering to carry a commission of only 1.5%, the lowest payoff that we have ever seen in common stock underwriting. Additionally, we made the amount of the offering open-ended, thereby repelling the typical IPO buyer who looks for a short-term price spurt arising from a combination of hype and scarcity. Overall, we tried to make sure that the B stock would be purchased only by investors with a long-term perspective. Those efforts were generally successful. Trading volume in the B shares immediately following the offering, a rough index of flipping, was far below the norm for a new issue. In the end, we added about 40,000 shareholders, most of whom we believe understand what they own and share our time horizons. Solomon could not have performed better in the handling of this unusual transaction. Its investment bankers understood perfectly what we were trying to achieve and tailored every aspect of the offering to meet these objectives. The firm would have made far more money, perhaps 10 times as much, if our offering had been standard in its makeup. But the investment bankers involved made no attempt to tweak the specifics in that direction. Instead, they came up with ideas that were counter to Solomon's financial interest, but that made it much more certain Berkshire's goals would be reached. Terry Fitzgerald captained this effort, and we thank him for the job that he did. Given that background, it won't surprise you to learn that we again went to Terry when we decided late in the year to sell an issue of Berkshire notes that can be exchanged for a portion of the Solomon shares that we hold. In this instance, once again, Solomon did an absolutely first-class job, selling $500 million principal amount of 5-year notes for $447.1 million. Each $1,000 note is exchangeable into 17.65 shares and is callable in 3 years at accreted value. Counting the original issue discount and a 1% coupon, the securities will provide a yield of 3% to maturity for holders who do not exchange them for Solomon stock. But it seems quite likely that the notes will be exchanged before their maturity. If that happens, our interest cost will be about 1.1% for the period prior to exchange. In recent years, it has been written that Charlie and I are unhappy about all investment banking fees. That's dead wrong. We have paid a great many fees over the last 30 years, beginning with the check we wrote to Charlie Hyder upon our purchase of National Indemnity in 1967, and we are delighted to make payments that are commensurate with performance. In the case of the 1996 transactions at Solomon Brothers, we more than got our money's worth.